before we get to the adoption, right, is practical expedience. And I know we've talked, you guys have spoken about this at various events that I've seen you at. Just, it's not as simple as just making a yes or no decision when you start looking at the list of expedients, right? Like you've said to me in the past that these are impacting not only the application of the standard, but how you guys actually create business process. It's not too different what you're just talking about right now with the completeness of the lease portfolio, but if you wanted to talk about some of the expedients that you think are important to really use judgment on and understand how they impact the business, because I think that's something that probably some of these individuals could use.
Yeah, we could be here all day with this discussion, so maybe I will focus on some of the expedients that maybe require a little bit more, maybe thoughtful analysis. Because again, you're right. I think when you think about the lease accounting standard, depending on your company, right, who are the users of your financial statements? How are they using those financial statements to make decisions that are critical to operating the business? How many leases do you have? What types of leases do you have? How complex are those leases? Will all dictate and impact how you make decisions around practical expedience. And so if you think about maybe the first one, and Mike made this comment to me earlier, and I really liked it, the three amigos, the package of practical expedients. So any of you guys that have been through adoption or are familiar, one of the expedients is it allows you to sort of an all or none approach, where if you take the expedient, you don't have to assess lease classification, you don't have to assess embedded leases, and you don't have to assess the initial direct costs, right? So however you accounted for those under 840, when you move to 842, you can keep those same elections or same treatments and then carry those in. And I think on the surface, that sounds like a really good approach. And I'll be honest with you, I've come across many or any companies that have not taken that package of practical expedience. It really does simplify the adoption. But there are a lot of things that you may have to consider when thinking about that. So if you peel back that onion, classification. Well, if you have a bunch of operating leases under 840, but because of changes under 842, they may have been classified as finance leases, arguably, because not saying anything, but maybe that's the case for us. Something you have to think about is that if you take the package, you don't have to reassess lease classification. But what happens if you amend that lease or modify that lease post-adoption? What if you enter into similar leases post-adoption? Well, now you're going to have those previous leases that were operating leases, and either you're now having to reclassify it as a finance lease because you modified it, or if you have a very similar lease that was executed after, that's a finance lease, but you have an operating lease, you may get questions from management or users of the financial statements as to why that is. Embedded leases, we've talked a lot about. There is a statement, or it's part of this package of practical expedience. If you have a service agreement and you said under 840 that there is not an embedded lease, that if you take this package of practical expedients, you don't have to reassess. Well, what happens if you modify that service agreement and under 842, you say there is an embedded lease? Well, now you have to account for that. So you need to be prepared. And we actually did this, and Jennifer, when she was with EY, helped us do some of this. So I'll give a nod to some of our accounting advisory partners, but we had to come up with a template for evaluating embedded leases. We said, well, hey, we're going to take the package of practical expedience, but can we take a look at a couple contracts that we know maybe all the things? And let's go ahead and go through the analysis so that we understand what the criteria are under 842, and are we prepared to do that analysis in the event that we modify or change that agreement. So again, with the package, and then the initial direct costs are the last piece of that. Under the new standard, you actually capitalize less in initial direct costs. It's a lot more prescriptive in what you can actually defer. And so chances are things that you had capitalized under 840 may not be permissible. So again, if you take the package, you don't have to reassess, you just keep them on the balance sheet, you keep amortizing those costs. But now when you have new leases, you may be capitalizing or deferring less. So it's just something that you need to keep track of. Hindsight, that's something that comes up a lot. It's another one of those practical expedients. Unlike the package of practical expedients, where I feel like most companies I've come across adopted, hindsight, on the other hand, I don't know if I've come across anyone who's adopted it. I'd say if you've got 10 leases or 15 leases, maybe it makes sense, right? Hindsight says that based on your conclusions around lease term, impairment, termination clauses, you're allowed to use what's happened since you executed that lease to determine that. So let's say you adopted 2022, you entered a lease in 2020, and you concluded that it was a 10-year lease term. Well, now you're adopting in 2022, and there's been some facts and circumstances that happened between 2020 and 2022. Yeah, you're like, I don't think it's reasonably certain or assured that it's 10 years. I really think it's 15 years, or I think it's 5 years. The hindsight practical expedient would force you to reevaluate that, set the lease term based on the facts and circumstances that exist, and measure your lease accordingly. Sounds great and all, but if you're having to do that for all of your leases, which by the way, if you elect hindsight, you don't get to pick and choose. You got to do it for all of them. That's a big lift, right? And if you're a company like ours with 2,500 real estate leases plus a slew of equipment leases, yeah, we ain't doing that. So yeah, no, we didn't. So we just said, okay, hey, whatever our conclusions were on lease term and everything else, as to adoption, we're going to continue to carry that forward. Really quickly, because this is going to sort of relate for discount rate and for combining lease and non-lease components. Both of those are practical expedients that you can elect. The discount rate is specific to private companies, but private companies are allowed to elect to use the risk-free rate, and they're allowed to do that on a class of leased asset basis. Similarly, with combining lease and non-lease components, as many of y'all are familiar with, revenue recognition guidance, if you have a lease arrangement that has both lease components, so the right to use an asset, but it also contains non-lease components, so think maintenance, think service agreements, you are required to allocate consideration of that contract between the lease and non-lease, unless you elect to combine. Now, before I get into those elections, both of those are available on a class of leased asset basis. Most companies haven't gone through that exercise. We haven't thought about what I think high level, it's like, okay, well, we've got real estate and we've got equipment. Well, if you look at the guidance on determining class of leased assets, it actually goes deeper than that. It's, well, there's physical characteristics of the asset, there's risk and reward. So you may have a piece of real estate like a piece of land, but let's say you own the land for corporate office space and you also own a portfolio of land for speculative purposes or to sublease or to have investment income. Well, one can argue those are two separate classes of leased assets because of the risk and rewards. And I think it's really important to identify what those classes are, because when you turn around and make these expedient elections, you need to have them documented. And so again, going back to combining lease and non-lease, I know some in the room are very passionate on you should always elect to combine. And there are some others where I think, we're not going to get into the technical details, but in some cases it's not really practical because you have non-lease components that are really significant to the contract, where if you were to combine, you would have sort of an anomalistic accounting result. And so, anomalistic.
That was excellent. I was actually going to say, not to interrupt the incredible language you're using, but Mike sparked up a bit. Mike has actually drilled our solutions consultants in the past on the lease and non-lease components, practical expedient. I wanted to make sure he had a chance to give his insights, because I know he has a lot to say about the thoughts here.
On the standard that I will set up here to say the standard is in the facts and circumstances that exist. I'll suffice it to say that you need to consider it, because if you combine lease and non-lease, what's going to happen? You include more in your lease payments if they're fixed, you have a higher right-of-use asset, you have a higher lease liability. Not great if your users of the financial statements or debt covenants care about those sorts of things. But what if you are a company that doesn't really care about the size of your lease liability? Or what if you have so much cushion in your debt covenants that if you were to combine lease and non-lease, it doesn't matter? Well, guess what? Combining lease and non-lease is going to create a lot more accounting simplicity in your day-to-day processes, right? However, some companies maybe are measured based on the size of the lease liability, or maybe based on the types of contracts, you would be doubling your lease liability if you were to make that election, and it just doesn't feel as palatable. Okay, well, that's fine. You just need to prepare your processes and systems to be able to do the allocation, because we're not going to draw it on the whiteboard. Mike would love to. He'd love to get on the whiteboard and start drawing it up. We've done it together. It's not as easy, or it doesn't sound easy. So it's not easy. So again, to answer your question, maybe broadly speaking, it's really important to think about all of the practical expedients, to think about by electing or not electing, what that's going to do to your financial statements, to how you're going to have to explain things to the users of your financial statements, whether that's management, whether that's debt holders, whatever the case may be, and then think about what your processes and systems are that are going to have to be designed behind that. And we have a very detailed impact assessment memo that we wrote with our election of all of that, so that not only we can provide it to our auditors, which is important, but so we can provide it to management, be like, this is what you're going to expect to see to our financials based on the election of each of these various practical expedients.
I think in terms of practical expedients, if you guys want a little bit of a cheat sheet, if you're going through and trying to prepare a similar type of memo, we have some blogs. If you go out on the Lease Career YouTube site, We have some blogs that kind of walk through some of the practical expedients and can help you figure out what to include there.